Thank you everyone for joining. We are very excited to have Samantha Azzarello join us. She's a frequent speaker on CNBC and Bloomberg, and she's also part of the key member of the JP Morgan research team, which we rely heavily on the data sets. And as everyone knows here at RVW, we are all data-driven and rules-based methodology systems. So we really enjoy working with their team to provide timely advice to our clients. So the title we have here is, are we at the beginning of the COVID-19? And we're not here to say that right now, based on some of the data sets, it looks like the situation is starting to get better, but really just to look at some of the data sets to see what we're looking forward for the next several months until end of the year to see 2021 and beyond. And before we go into that, we really want to introduce some of the methodology that we really study and use for our clients' portfolios. This is what we see in terms of the different factors. So last webinar, we really touched upon quality. And some of the examples of different factors are, again, value, momentum, and quality. And these are some of the different factors that will allow to outperform over time compared to some of the more widely used indexes out there, such as the S&P 500. And how really this all comes together is this slide. So there are different ways to access factor. And what we mean by that is there are single factor investments or ETFs that clients can use to have exposure to different ways, such as momentum, again, or value. But then there are ways, if you see on this left side, multi-factor ways to really increase return and reduce volatility over various market cycles by reducing the core market cap exposure. Because as we always put it, with market cap, it's one way to access the most overpriced companies at that point in time. And now how that looks once you look into really the microscope and see how it's coming together is if you're looking at the different weights. So you have different sectors on the left side. This is very important because if you remember back in year 2000, technology, if you see number 8 column here within the S&P 500 sector, it was the biggest weighting at that point in time. It was nearly 50% of the index, and it grew from about 20% all the way to 50. And that's partially why when the tech crash happened, we had the result of a lost decade. From year 2000 to 2009, S&P 500, so the largest US 500 stocks, were the only groupings of companies to lose performance over the 10 years. So by really looking at the sectors and having a better weight between the 10 different sectors, it's a better way to access the companies. And if you're looking at the right side, you have the factor screens. We have value, quality, again, momentum, and really touching upon quality, it's again, factors like profitability, financial risk, meaning how much debt the company has, and earnings quality. And interesting enough, few weeks ago, the fund that we use with JP Morgan, it added Campbell's Soup. And that's partially because it's had low debt, which is healthy, and obviously the earnings quality continue to improve in times like this when people were stocking up on soups. So Campbell's Soup was included in this particular fund, and we've seen a good performance out of it. And now how does this look if we're looking over the entire total market cycle? And here is about 16, 17 years of history, dating back all the way to 1999. You see S&P 500 index, again, market cap weighted. Another way to look at that is, again, most overpriced companies at that point in time have the biggest weighting versus what we see in terms of weighting between value, momentum, quality. You know, if you blend all those different factors together, what you're seeing is capturing most of the upside of the market while really minimizing the downside. And that's what we're seeing the benefits here when you're combining the different rules-based methodology. So we really wanted to highlight that because Sam will touch upon it later when she speaks. But yeah, this is an overview to look at how all those different factors come together. And Selwyn will look at the next phase. Thank you. Selwyn, you're on mute.
Okay, unmute. Okay, I'm there. Can you hear me?
Yes.
Perfect. Good morning, everybody. Good evening. Good afternoon. We have folks with us from all parts of the world, all parts of the country. It's great to have you with us. As Stefan has tried to show you, our approach tends to be, when you look at the spectrum of art versus science, we tend to be much more towards the science than the art. And we sit on the shoulders of great people. That's how we get to see reasonably far. I'll kick off with some of the statistics that I think you may not be aware of. This is what we're currently seeing. And as you already know, we're about data. We live in the present. Some people who pretend to be wealth managers are in the forecasting, predicting, anticipating business, led by the Wall Street analysts, for whom we have generally a profound disrespect, as you know. We don't use binoculars to see what's happening in the future. We live very much in the present. And as Stefan showed you with an example, the funds we use to access quality equities, try wherever possible, wherever it's feasible or possible or practical, to look at what's currently happening. And his example of Campbell Soup was a great example. So our portfolios are adjusting in real time to where the action is, which is why we don't really have to worry about what the post-corona will look like, because our portfolios will, in a dynamic way, automatically, because of the rules-based system we apply wherever possible, and the other technologies that are science-based, mathematically based, computer-based, to make sure that the portfolios in a dynamic way are adapting to the current situation. I thought it'd be good to take a look at this because we see over here, and this is current as of an hour ago, you see what looks like, and we hope will continue to be, a trend of capping out and hopefully declining of daily new cases. So this is the current US situation as of a few hours ago. And Stefan, if you could just show us the next one, you'll see what the deaths look like. And once again, you'll see those are coming down as well and certainly appear to have capped. All of us pray and hope that this is the beginning of a trend. But of course, one doesn't know with this very, very weird and cursed, tragedy that has befallen mankind. We don't really know how it'll end up, but or when it will end. We don't try to do that, but we do see, as the title says, the beginning of the end. And once the treatments are finalized and approved, and the vaccination comes out, which is really what it's going to be all about ultimately, is a vaccination. We will reopen fully, and until that time, of course, it'll be partial. Let's continue down and take a look at the slides that we have. Here's Warren Buffett, of course, telling us that it's a terrible mistake to bid against America because our golden goose of commerce and innovation, and especially innovation, the great capitalist machine that innovates, will continue to lay larger and larger eggs. So, and we pay attention to Warren Buffett. Forgive me. Let's go to the next slide if we can there, Stefan. Here's the biggest problem most investors face. Basically, it's called, believe it or not, bad behavior. That's the technical term. And basically what people are able to do is when things are going well, they're very happy to be in the stock market. They think it's always going to be a bull market. And when things go badly, they tend to sell. And so most people have an investor experience, an investor return that is significantly less than the market return over the period that they were invested. And that's because most people get in at the top and out at the bottom and can't figure out why on earth they're having a bad experience with equity. And so this behavior gap is probably our biggest challenge at this point. For wealth managers like us, the biggest challenge we have is where nervousness creeps in, and we sincerely hope it ought not creep in, because our entire business, our entire practice is about education rather than sale. And everybody who's a client knows that the market behaves in this strange way. And the key is to stick in, buckled in for the long ride, and be prepared for turbulence. And that's what we have right now. So this behavior gap is the biggest danger to everyone's wealth, and something that should be guarded against. Now, Warren Buffett talks about Mr. Market, and he learned this from his teacher, Ben Graham. And I think the way that he views the market will help us all to deal with volatility in a better way. Almost verbatim, Warren Buffett says that when you own a group of quality equities, it's as if you're in partnership with a bipolar fellow called Mr. Market, a mythical character who's your partner in this group of businesses that you own with him. And every morning he knocks on the window and tells you what he's willing to pay you for your share of the business that day. And your job as an investor is to ignore his knocking on the window, because when the market is up, that's a result of him feeling good, happy, optimistic, ebullient. And in those days, we call that a bull market. He's offering you an outrageously high price for your share of the business that you own with him. And then he goes through periods of being forlorn, depressed, downtrodden. We call that a bear market. In those times, he's going to offer you just a pittance of what the true value is on those days. And here comes the Buffett wisdom. And if there's one thing you take away from this presentation, please let it be this. In the short run, the mood swings of this mythical fellow will determine the price of what you own. But in the long run, the true value of what you own is determined by the profits earned in the companies you own. And we think of ourselves as owners of fractional interests of companies, and with a searching and seeking mechanism that overweights towards the best companies and underweights towards the worst companies in a dynamic and real-time manner. That is what we do. So Mr. Market is our friend, because if we can handle his mood swings, we have been for 200 years very well rewarded for enduring that volatility. I also want to distinguish risk from volatility. By the way, here, it's worth taking a look at Buffett's exact quote. The investor's worst enemy is likely to be himself. And of course, you know, as someone who comes from South Africa and someone who's been on safari many times, you watch the animals in the wild and you see how they are genetically bred to herd when they feel comfortable and flee when they sense danger. That is the mechanism that triggers the worst behavior in the market and causes great investors to chicken out, to bail out, and not be there for the great fruits that await those who understand how markets work. The core over here, and if we can just go down just a little bit, the key here is, and I think this is a very important slide from Larry Swedlow, quoting Napoleon Bonaparte. What he basically talks about here is that it's all in the planning. Clients of RVW have a portfolio that reflects anticipated cash needs over a reasonable period going forward, and the goal is to make sure that the secure part of the portfolio, which we call the safety bucket, will be there no matter what. That is our goal. That is our search, to make sure that the portfolios have, where appropriate, two buckets: an equity bucket that will move up and down with the market, although we know that over time it has moved up dramatically, and those who have stayed buckled in have been generously rewarded. And then there's a safety bucket, so that there's never a need, or never an anticipated need, to sell when the market is down, which, as you can probably already figure out, is the only way you can lose money in a well-designed long-term portfolio, is to sell when the market is down, because there's not a single problem, not a single geopolitical or economic problem the world has faced over 200 years of research, and you can check it with Professor Jeremy Siegel in his great classic book, Stocks for the Long Run. Not a single problem that wasn't resolved by the passage of time.
Okay, it's Jonathan Gerber here. I'm going to spend just 2 minutes going through a couple of reinforcing slides that every equity investor should review before we turn it over to Sam, so that we can get her on the screen by 8:20 a.m., which is 4 minutes. So really quickly, one of the unique reasons, elements of our firm is that we are pure fiduciaries. When people come to us to discuss their portfolios and their financial advice, we put their interests ahead of our own, which makes us a very unique, select firm when you look at the marketplace, where most wealth advisors have what's called a duty of suitability, which is where their duty ends when they've, broadly speaking, defined the appropriate asset class. Our duty to the client is higher than that, where we have to see it all the way through to make sure that we're implementing with the best, lowest price available tools to get the best possible outcome we know to achieve. And it's quite unique when you work with RVW Wealth that you get a pure fiduciary role. If you're not currently a client, ask your advisor the following question: are you always a pure fiduciary? Are you always a pure fiduciary? And if there's a stutter or a pause, give us a call. Next slide, Steph. This is looking back at the last market collapse. If you had been the investor who had gotten in on the worst moment before the collapse and you had invested $10,000 in the market, there would have been a moment where that $10,000 would have turned into $5. But it now would have been worth 30 or 35 if you had added back the dividends. And I say to you, who cares that there was a moment in time when your portfolio was temporarily, artificially devalued by some manic depressive pricing machine called Mr. Market? That 10 is now worth something like 35. And we say, who cares there was a moment when it was worth 5? And you have to have that equanimity when being an equity investor to pass through the tough times, knowing that equity investing works over time, not all the time. And every one of these vertical bars is a calamity that we got through. And this too shall pass, as Solomon said. We'll go over one more slide before we, or two more slides before we pass it over. This is a bull versus bear market run from 1926 to today, including 2 world wars, Great Depression, and yet look at this. It's overwhelmingly a blue slide representing bulls, interrupted by short orange spurts of bear. They call them bulls because bulls kill up and bears strike down, by the way. And this graph shows the width, meaning the time, and the height and the depth of the growth and collapse. And when I look at this, I basically see one big bull market interrupted by short orange spurts. And in order to earn the blues, you must be willing to endure the oranges. And that is the takeaway here. When you look at the pricing of a stock, I'm going quickly through this last slide before I turn it over to Sam. One really must go back to the fundamentals of what are you buying? And what you're really buying is the present value of all future earnings. That's what you're buying when you buy an interest in a company. Only about 10% of the value of that stock is determined by the profits projected in the next 12 months. Only 10% of the value of that stock is expected to come from the growth or the performance over the next 12 months. About 90% of the value is derived from income from month 13 and beyond. It's hugely important. So even if you believe that in the next 12 months will be painful, which I don't want to discourage or dissuade when this thing will end or how soon we'll normalize. The fact is, if you want to understand the wild US stock market rally, forget about 2020. With that, I'll turn it over to Sam. It's a great honor, Sam, to have you with us. We're grateful and honored to have our relationship with your firm. And I'm going to unmute everyone and bring you on, Sam. So thank you very much.
Thank you very much. And I hope everyone on the call is doing well and healthy, staying positive and calm. There is a lot happening, right? So it's always about figuring out what the signal is from all the noise. And I want to start with this idea around which sectors have been impacted the most, right, by social distancing. And that's what we're showing on this page. And the key point, because there's a fair amount of data here, is if we think about hotels and tourism, airlines and cruises, entertainment, restaurants and bars, and then retail, those are really the big 5 mega industries that have been most impacted by social distancing, right, as a byproduct of the economy being shut down and everything that's happened to date with COVID. But a key point that I actually want to make here is that there are some divergences. And what I mean by that is, while these 5 industries are unbelievably important when it comes to employment, they're less important when it comes to earnings in the S&P 500. So on the left-hand side of the page, what we're showing is that 20% of payroll jobs, so 1 in 5 jobs, are in this sector. That is why we've seen the job losses we've seen, and we're going to talk a little bit more about that later. And it's not at all about being callous, but with respect to the S&P 500, with respect to equities, these sectors only encompass about 7% of operating earnings. And while everyone, I would argue, is being impacted by COVID, some are being impacted more than others, and these are the industries that we really have our eye on because these are the ones that we think are going to have structural changes after we come out of this, and these are the ones that are going to be hit the most. That said, not the biggest piece of earnings. I want to just pause for a second and talk about recession, okay? And then we're going to talk about federal finances, but this idea that these sectors have such a huge play in the labor market, what does it also imply for the shape of the recession? So we like to use letters to explain recession. Some of you have probably heard this. Some people are talking about a V-shaped. A V is what we're actually expecting in China, and that is just the path of growth falls, hits the bottom, and bounces back up. A W is another shape of recession. That's what happened to Europe in 2012. A W is a double dip recession. We do not want to see that. That's not our expectation. Another example of a letter that represents a shape of a recession is an L. L is in Larry. That's what happened to Japan in the 90s. So growth takes a massive drop down and then basically mulls at the bottom, meanders across the bottom, and you don't ever really recover. What are we expecting in the U.S.? And I focus on the U.S. because in our view, the U.S. is still, one of the main engines of the global economy. I would argue it's the U.S. and it's also China. We have two orbits of power. But for risk sentiment to really turn back on, we need the U.S. to be recovering. So the U.S., our expectation is the recession is U-shaped. U as in ukulele, which is a tiny little guitar for those who might not know. I could also say umbrella. U as in umbrella. But the U-shaped recession is in second quarter, we're going to expect a massive drop in GDP growth. But keep in mind, it's expected. So everything is always about expectations. Even though the data is going to come in very grim, that second quarter GDP number we think is going to be about negative 15%. It's going to come in line most likely with expectations. The issue arises around the bottom, right? So the bottom of that U-shape, how long do we stall? I'm in agreement. We need a vaccine. We also need to go back to work. We also need to figure out contact, like social contact and how we measure that. We lost track of contact tracing a couple months ago. We need to gain that back under control, but I'm very optimistic that the tech companies and that massive partnership that was announced over the weekend is going to be unbelievably important, and it's a very good sign. I took it as very positive news that we get that back under control. So we're stalling at the bottom and then we're surging on the other side. Okay, so I think the biggest question mark is, well, how long do we stall at the bottom? It really all comes back to the data stabilizing and coming down with respect to the virus, and then we can go back to work in rolling waves. A few things to keep in mind. When we surge on the other side, it's going to be a lot of pent-up demand that's going to come back. Now, delayed demand is concentrated in durable goods. Delayed demand, you get back, you don't even worry about it really, because you didn't buy the washing machine or the car or the house now. You'll buy it after this is said and done. None of that purchase impulse is going to go away. An issue we see, something worth thinking about, is demand destruction. Demand destruction is concentrated in the services, and many advanced economies are service-based economies. And that simply is the idea that, if you go out with your partner, for Mexican food every Friday night, well, you're not going to go out twice as much when this is all said and done. So that meal out or that service you didn't consume now, we're not necessarily going to get it back twofold when we come back. I do think you'll see increased demand for services. Obviously, that'll be pent up too, and everyone's going to be back at it. But it's something we keep in mind, this kind of interplay between delayed demand, which is good, we'll get it, and then demand destruction, which is arguably not as good. But what else is going to take us through the bottom of the U-shape and help us surge on the other side? It's the federal government being very supportive, which is what we're going to talk about next. And on this page around federal finances, this is just some detail around the CARE Act. And then on the right-hand side, we're showing what some of those implications are going to be for federal finances. I will say this simply. Right here, right now, is not the time and not the place to worry about federal finances. We've been getting that question a lot. I understand the genesis of it. But where we are right now, we need fiscal stimulus to basically be a bridge to get the economy where it is right now over this abyss and to the other side. And it's interesting, I've heard many people say, we're going to get through this. I like to say we're getting through this right now. That's what we're doing. We're moving through this. And there is light at the end of the tunnel. All we have to do is look at China and the way they're reopening and look at some of the infection curves around the world that have started to stabilize and come down. So getting back to this idea of the CARE Act and this bridge, right? We need this fiscal stimulus bridge to be long enough and wide enough to get as many people over as possible. And in particular, I'm thinking of consumers and I'm thinking of small and medium-sized businesses. Corporates are important, don't get me wrong, but corporates have buffers. Corporates can tap on lines of credit. Corporates have big balance sheets. So yes, some industries are going to be getting bailouts like the airlines and potentially some of those sectors that we started on. However, this is really about getting small businesses and individuals over to the other side. So we put some details on the left-hand side of this. I just want to point out a few. The first, about $260 billion into expanded and extended unemployment benefits. We're expecting a second and a third wave of fiscal stimulus to widen the bridge and lengthen the bridge to get us over, right? And I would expect more to be done on the unemployment benefits, even though they are very generous and very appropriate for right now. Also, lots of loans to businesses. So just to put some context around this, Small Business Administration, which is a small but powerful group within the U.S., they did about $50 billion in small business loans last year, 2019, which feels like it was 7 years ago at this point, but last year. This year, right now, they're doing $350 billion in about 3 weeks. And our expectations is that that whole facility is going to be capped, and we do expect the government to do another round. So this amount of spending they've done, you can see the number, it's about $2.3 trillion. Just to give you some context, compared to 2008, this is 3 times the amount of stimulus that we received in 2008. And this time, this recession, so it's U-shaped, I mentioned that, but I would also mention one other thing. This is not a cyclical recession. Cyclical just means you're on a roller coaster, you get to the top of the roller coaster, and it's naturally time to come down. This is not cyclical. This is also not structural. 2008 was an instance of a structural recession. I would argue structural recessions are the most lethal. That's when you have big buildups and you have bangs, pops, bangs, bubbles bursting. That's also not what this is. This is obviously unprecedented and a prime example of unknown unknowns. But I would say that this is an event-driven recession, very similar to a large natural disaster or a war. Okay, so keeping that in mind, that's where we get the U-shaped recovery view. Finishing up on this page around the federal budget. So obviously nothing good right now is happening with federal finances, but again, I'm going to reiterate, it's not really the time to worry about it. And you know, what makes this kind of tricky is there's no line in the sand. And I actually think human beings do better with lines in the sand because we know when to stop, right? We know when not to push. We know when not to go over the line. And what I mean by this is there's no line in the sand in terms of government debt levels that then become punitive. There just isn't. I mean, we can keep pushing the boundaries of government debt. And there's nothing to say that you get to a certain level, right? We look at it as debt to GDP. There's nothing to suggest that we get to a certain level and the system breaks. That's just not the case. And we have to keep something in mind. The U.S. is afforded a very special perch. Everyone buys our debt. Global investors, retail, right, all types of firms, institutional, they use treasuries as a ballast in the portfolio. So there is always this constant demand for U.S. debt. And not other countries have that benefit. Not other countries are given that, you know, that kind of leeway to issue debt and it be absorbed by the market. This is a key point because whether you believe in big government or not, I'm sort of making the case that this doesn't have to be problematic, especially since who's buying the debt right now? It's the Fed. Right, the Fed and the Treasury are coordinated right now. I'm not going to say cahoots, but they're working together. They're being coordinated that the Treasury is issuing all this debt and the Fed is absorbing it onto its balance sheet. That being said, what does this mean around interest and how much we spend on interest? Well, you know, it's cold comfort, but we should take it. Much of this debt, actually a majority of this debt, is locked in at very low interest rates. We're not necessarily showing that on this page, but I looked this up for the group because I wanted to make sure to mention it. A lot of this debt is being issued at very, very low rates, so at a low interest expense to the government. That being said, when could it be problematic? Well, when you have to roll it. When you have to roll it and lock in new rates on it. We don't think rates are going up for a very long time, but we'll talk a little bit more about that soon. And by soon, I mean on the very next page. We're going to talk about interest rates. So this idea that rates have to stay low because there's a lot of government debt, it has a name, okay? And that name, it's called financial engineering. And I believe in emerging markets and investing in emerging markets. But just to give you some context, this is generally something that emerging markets have done in the past. certain countries, not all of them. And that's that idea that you have collusion almost between the central bank and the government issuing debt and basically saying, hey, central bank, you can't really raise rates because we need rates to be low to kind of keep this debt machine churning. That's one scenario. That is not at all where the US is, and I would argue that's not where Europe is. But there is growing awareness that at some point it's going to be hard for rates to go up for various reasons, right? A plethora of reasons. But part of that is, well, we also have a lot of debt, right? And a 10-year Treasury bond issued at 70 or 60 basis points, aka very cheaply as it is now, is a very different situation, very different than it being issued at a 3 or 4% yield, right, which is arguably much harder on federal finances. So I do think this new cycle is going to be characterized by a lot of fiscal stimulus. Every cycle is different. Every cycle is unique. And we're in a new one right now. The last 10, 12 years, that cycle was characterized by a lot of central bank stimulus, right? Central banks front and center, the Fed, right, up in the markets business, basically. This new cycle, I really do believe, is going to be characterized by a tolerance of more debt, just higher debt levels. So these are things, kind of mega trends we're thinking about after COVID, because there will be an after. But with respect to what the Fed's doing, I just want to talk about this quickly. So the Fed brought rates to zero. That was not the only thing that they did. They also announced about 5 different credit facilities, which we have listed on this page. Acronyms aside, right, I want to make the point to you that on a high level, what the Fed did was to help markets function better, okay? And that, in my mind, is what I call financial plumbing. So thinking about your own plumbing, the point is you never, ever think about it until there's a problem with it. It's the exact same with financial plumbing, right? So we go to transact in ETF land, or we go to get cash from an ATM, or we go and a municipal tries to issue a bond, right? Or all the financial transactions that happen day to day, that's financial plumbing. And basically what happened a couple weeks ago was there wasn't enough water or liquidity flowing through all the financial pipes, right? Some of those pipes were drying up, and that is problematic. That exasperates any issues you might be seeing in the economy. We need financial markets to be running smoothly for many, many reasons, but especially in times of uncertainty and times like we're experiencing now. So the Fed, what they basically did with all these credit facilities is they're pumping a massive amount of water, a massive amount of liquidity into all the financial pipes to make sure that everything's flowing smoothly. So no, this doesn't fix the macro situation, but this does something unbelievably important on the financial side, which is it keeps financial markets running smoothly. The Fed is also going to be very focused on unemployment, and that's what we're showing on the next page. So we started with this idea that 1 in 5 jobs are in these COVID-centric, right, really impacted industries. And you've already started to see that in the unemployment insurance claims. So every week, right, we're seeing 5 to 6 million more people losing their jobs. And, you know, this is, again, expected, but it's a problem because the consumer is the heart of the U.S. economy. So we need to figure out a way after, as we're moving through the bottom and up on the other side, we have to figure out how to get to the other side of this. Now, the unemployment claims, that's going to keep increasing. And when this is all said and done, there's going to be about 20 to 25 million people who have lost their jobs. Now, they're getting supported with that bridge, right, with that fiscal stimulus on the other side. However, we're going to have to do a lot of work to get everyone back to work, and this is going to be unbelievably important. Moving to the next page, my computer froze up with terrible timing. So, Stefan, can you tell me what the next page is after unemployment and wages while I try to reconnect my computer?
The annual returns and intra-year declines, one of our favorite pages.
Wonderful.
My favorite slide.
My computer is so temperamental, and it knows
I'll take this slide for you, Sam,
okay.
while you do that. Okay. So actually, it wouldn't be a complete RVW Wealth presentation if we didn't include this slide. What we're showing you here is the peaks, is the intra-year declines from 1980 to this year. It's the gray bars on top are the performance of the S&P in each year, and the red dot below each bar is the drop for the worst second of each trading year in each year. So if you take a look at 1980, for example, the S&P delivered 26% for the full year. But there was a moment in time where the S&P was down by 17%. And in virtually every year, there's catastrophic intra-year decline. So the average intra-year decline for this 40-year run is about 14%. But the average full-year growth in each year is about 9%. And the way I look at this slide is the cost of earning that annualized rate of 9% historically is the willingness to endure a 14% intra-year decline. Sam, are you ready to take that?
I'm back. Thank you
great.
very much. You did that better than I could have done it. And I'm very glad that we used that page. That's teamwork. And yes, I mean, it speaks to this idea that we zoom out, right? We've been rewarded for staying invested in markets. It's just, unfortunately, it's times like this, people without financial guidance, right? People who don't have the help, they lose faith in investing. Many of you on the call, though, I know you're getting financial guidance from an amazing firm. So that's kind of the difference. We just find that this is when people tend to make mistakes, and they make emotional mistakes, and we have to avoid it at all costs. So moving to the next page, which is just a little bit of another dive into market volatility. We're in a high volatility regime. Okay, and regime, I guess, is sort of a fancy word, but we were in a period of very low volatility for years and years and years, and that is what we all got used to. That's human nature. We got used to it. Obviously, that's all shifted. Volatility is unbelievably high. That's what we're showing on the bottom panel. The VIX is just a measure of volatility. Some people call it the fear gauge, right, in the markets, and it's high. It's also come down, though. So again, I really want to point out the silver linings to you, because I've personally found all media, doesn't matter what leaning it has, is very negative right now, and we have to keep perspective. So the VIX was unbelievably high. It's come down, but we're in a high volatility regime. And what's interesting is days are not independent. Okay, so one stock market day is definitely linked to another stock market day when it comes to volatility. So if you've had a lot of market swings yesterday or last week, it is more likely that you will have market swings the following week. That's the way this idea of the regime works. So I want to get that on everyone's radar, because we should expect more of this. It's not necessarily telling us anything new, but it's important to keep in mind that market swings up and down, right? That's both indicative of volatility. I find that sometimes we tend to think volatility is just the market going down. No, I mean, it's also the market going up, which is what we saw last week. I want to turn topics a little bit and talk about oil, because oil's been very, very front and center. What happened with the oil deal, I would argue, was good. Structurally, long run, it doesn't fix oversupply, right? You've got a lot of players who are capitalistic. The U.S. is going to keep pumping. Canada's going to keep pumping in the longer run, which puts downward pressure on oil prices. But at least what happened now, if we're looking on the right-hand side of the page, I would argue any bit of stability is better than none. We'll take stability from any sector we can get right now. So oil having a bit of a bottom because of OPEC Plus, led by Saudi Arabia and Russia, along with the G20, put in a bunch of measures in the deal. Some people think the deal is not enough. I'm not in that camp. You know, like, I don't ever think that trying to control prices is the way to go. That being said, the support and this idea that all countries are going to be buying up oil for their strategic reserves is going to help demand a bit. Saudi Arabia and Russia, who, you know, they're the kingpins of the old oil world. I would argue, frankly, the U.S. is it's the marginal producer, and it's where all the growth is coming from. But right here, right now, sentiment is being driven by OPEC. So what they did by cutting 10 million barrels a day was good, and this is going to help prop up the oil price and provide a floor. And this is a positive because gas prices have been low for a long time. I'm convinced consumers are a bit more desensitized. Any more drop, it would be nice in gas prices, but it doesn't feel necessary because gas prices right now aren't punitive. Oil being stable is more important for the global economy and for energy industry, because the energy industry, they spend a lot. You know, whether you believe in big energy and fossil fuels or not, but energy companies spend a lot on CapEx. they're very supportive of the global economy. This ties into services momentum, which I want to touch on quickly before we end with the last 2 pages. So I mentioned this idea of services, right? Many of us are service-based economies. So this is services momentum. This is all very red. We are watching this. This tends to lead growth. So this is very interesting data. This is a diffusion index. So anything above 50 means expansionary, and it's going to be marked as green on the page. Anything below 50 is contractionary, and it's going to be red. Obviously, there's a lot of red for March. Again, that's in line with expectations. We are going to be watching for just slight improvements. We're going to be watching for this data to be moving slightly more orange and then yellow, which it will as we come back. We're in a sharp contraction, but we're going to come back from this. But I just like using this page because, one, I like the colors, but also just this is a very informative page because this tends to lead growth. This is forward-looking. So this is monthly data, which it's not a real-time tracker, but monthly data is pretty fast considering we only get GDP data quarterly, right, every 3 months. So this is data we want to be watching. I want to end on this page here. This is the page I want to end on. This is around factor performance. So I already touched on quality. I think if there's one overarching theme right now, it's quality, right? We want to have a quality bias because that makes sense. The times are uncertain. So this is what we call our quilt chart, and these are the different factors, momentum, multi-factor, which we are big proponents of, which is diversified, value, defensive, min-vol, quality, small cap, high dividend, and cyclical. And just want to point out this idea that over the long run, quality, which is the light blue to gray, it tends to do quite well, annualized return, with a lower amount of volatility, which I think is interesting because, yes, you can have something that performs well, but it might also have too much volatility associated with it. And it's always a balance and it's always a trade-off. Multi-factor also is interesting because, if you abide by the idea of diversification, which is just, not having all your eggs in one basket, that makes sense. And I do believe that idea of diversification can be extended to any subset of investing in terms of the way we think about it. So I want to thank you all for your time. I hope this was helpful, and I want to turn it back to Stefan.
Thank you very much, Sam, and it's wonderful to be working with JP Morgan's asset management team, so thank you. And with that, if there are any questions, please email my father, Stefan, or I. We would love to dive into any questions you have. Email us and we'll get back to you. We can set up a meeting, go through the details, and our clients will be getting their quarterly reports within the next 24 hours, and we'll definitely be in touch after that. So thank you, and with that, we'll formally end the call. Again, questions should be sent by email, and we'll respond and set up times to address them on a one-on-one basis.